The sustained uptrend we've tracked across major U.S. indices is cracking under the weight of aggressive selling. The market's structural integrity is fracturing. Before we dissect the charts, a mandatory reminder. This technical analysis is strictly a personal perspective for educational purposes. It does not constitute financial advice. Active market participants are currently confronting a single vital question. We are seeing a localized bounce, but we need to know if this is a genuine trend reversal or simply a lower high consolidation preparing for a deeper breakdown. Analyzing any single index in isolation right now creates a significant blind spot. The internal signals are currently contradictory. Specifically, there is a severe divergence in relative strength between the tech-heavy Nasdaq and the industrials-heavy Dow. This conflict is masking the true underlying risk to the broader market. Surviving today's session requires us to actively diagnose this fracture in relative strength, rather than relying on generalized macro assumptions. Following any steep sell-off, the market inevitably produces a relief rally. This predictable bounce often acts as a psychological trap. Novice traders see these localized, low timeframe bounces and frequently misinterpret them as definitive macroeconomic bottoms. They assume that the pain is over. However, a distributional trend, the phase where large entities are actively reducing their exposure, relies on these exact moments. Institutions use these minor relief rallies to quietly offload their assets directly into retail buying pressure. Establishing a true, sustainable market bottom requires coordinated, synergistic buying pressure across all major sectors simultaneously. Capital must flow in collectively. We do not have that synergy today. Instead, we are looking at a highly fractured reality where the major indices are acting completely out of sync with one another. In this specific volatility regime, evaluating price action on its own, without examining the corresponding volume and underlying structure, carries heavy risk. To understand the illusion of the current recovery, we have to pull apart the S&P 500 benchmark to expose the sector decay beneath the surface. We establish our macro-technical context by starting with the S&P 500 on the 1-hour time frame. This chart shows the S&P 500's hourly price action. Notice the clear descending structural pattern originating from the mid-July peak near the 7,560 level. The index has printed a consistent sequence of lower highs and lower lows. Look closely at the volume signature during the recent capitulation event near 7,400, specifically around the 24th and 25th of the month. This massive clustering of high volume directly at the structural lows indicates a localized institutional defense of that specific price level. Buyers stepped in aggressively to absorb the selling. But here is the critical bearish signal. Despite that massive institutional volume defense, the subsequent bounce only managed to yield yet another lower high. The failure to break that structural sequence of lower highs proves definitively that sellers remain firmly in control of the broader index. The buyers defended the low, but they could not reverse the trend. This sequence of lower highs suggests the S&P 500 lacks momentum for a trend reversal. To find the source of this resistance, we must look at its primary growth engine, technology. The technology sector acts as the primary engine for market-wide momentum, making its trajectory our focus.
This is the 1-hour chart of the Nasdaq 100. The price action here is completely detached from any bullish or recovery narrative. It is locked in a steep, ungalanting downtrend with virtually zero upward retracement. Look at the far right edge of the chart. The index is hovering precariously near an immediate, highly fragile support zone around the 27,800 level. Unlike the S&P 500, which at least attempted a modest bounce, the Nasdaq has failed entirely to mount any sort of recovery rally off its recent capitulation lows. This weak, sideways consolidation at the absolute bottom of a downtrend is structurally dangerous. It forms a high-probability bear flag, suggesting the market is merely resting before a further breakdown. Because of this heavy distribution, the tech sector is acting as an anchor. It is dragging down every attempt the broader market makes to bounce. With the heaviest index components pinned to their lows, a macro market recovery becomes mathematically improbable. The industrial and value sectors, however, are communicating a distinctly different structural story. This chart displays the 1-hour price action for the Dow Jones Industrial Average. In stark contrast to the Nasdaq's complete capitulation, the Dow executed a strong, sharp V-shaped bounce originating straight from its recent lows. Right now, the index is making a clear structural attempt to form a critical higher low around the 52,208 level.
Establishing a higher low after a severe sell-off indicates deep relative strength. It proves active institutional accumulation is occurring within the industrial sector. When we compare the Dow's active accumulation directly against the Nasdaq's structural failure, we see a textbook example of intermarket divergence. The major indices are moving in opposite directions. This divergence indicates a deliberate capital rotation out of technology and into value. Liquidity is shifting between sectors rather than exiting the market entirely. This fracture between sectors creates a volatile, low-conviction environment. The indices will actively battle each other for directional dominance, leading to incredibly choppy price action. All of this structural data places the market at a highly precarious, volatile inflection point for the upcoming session. The tension is perfectly balanced. The bearish trigger is clear. If the Nasdaq decisively breaks below its immediate 27,800 support level, the floor drops out. A tech breakdown of that magnitude will inevitably drag the broader market down with it. It would instantly invalidate the Dow's fragile higher-low structure and trigger severe trend continuation to the downside across the board. The neutral to bullish alternative relies entirely on the industrials. The Dow must maintain its relative strength and successfully defend that 52,200 support level. If the Dow holds, expect highly choppy rotational price action today. Capital will continue to slosh back and forth between tech and industrials without committing to a directional macro trend. Expert technical trading requires reacting to these probabilistic scenarios exactly as they unfold on the chart. It is never about blindly predicting a guaranteed outcome. In a severely divergent market, your directional conviction must remain low. Let the real-time resolution of the Nasdaq's critical support level dictate your ultimate short-term bias.